Joining us today, JP Morgan's chief U.S. economist, Michael Feroli. Michael, happy Friday. Appreciate the guidance today. It's great to have you. I think in general, your framework has been that Q1 is resilient, but it's Q2 where we're at least on guard for a drop-off in the consumer, right?
Well, I thought this morning's number was actually fine. Some of the weakness we saw in March was, related to gas station sales. Also, the January level was huge, so we're kind of coming off of that. It was supported by some one-offs, but overall, I think the picture looks okay for the momentum heading into the second quarter. So I don't think second quarter may be tough to match the first quarter, but still, it doesn't feel like we're kind of slipping off the precipice here or anything like that.
Right. I did notice a chart you guys published last night, basically looking at claims in the wake of some of these revisions, and it feels like, what's the number? Is it somewhere around 250K, where if you do meaningfully shoot up above that, then you might start building in more of a recession playbook?
Yeah, we're not there yet. We had a little bit of a drift higher in claims in January and February. They look like they've stabilized over the past few weeks. But I think if we are going to have a recession sometime in the next few quarters, we would expect claims to drift higher and payrolls to slip into negative territory. But we're pretty far from there right now.
Larry Fink this morning at BlackRock, which is another big winner in today's session with all the inflows, Michael, said that he doesn't necessarily see a recession happening in 2023, and maybe 24, a shallow one, doesn't see a very big one. Is that something that you agree we can get away with at this point, with all of the monetary tightening, the high inflation, and now the worries about bank lending?
So, our main view is that we have a mild recession starting very late in the year. So I would agree with the point that, we could get out of this year without a recession. I think the question is, can we have a disinflation from where we are to something closer to 2% without a recession? Historically, that's never happened. I mean, we don't have a ton of data points on this type of inflation, so it's possible. Hope's not unreasonable, but the history would suggest to get back to inflation around 2% would require a rise in the unemployment rate of above a percentage point, which would be associated with a recession. So I think that's, again, the most likely scenario. One can always hope that we have something a little more benign, but I don't think that's a starting point that I would think about.
Do you think the market catches up here more with the Fed? Because the lines from the Fed, and I know there's a little bit of divergence lately, but it's basically not convinced yet on the disinflation story enough to pause or think differently about the outlook. Yesterday I was at the IMF meetings. The managing director said, yeah, it's coming down, but not fast enough. There's still more work to do. And that appears to be a consensus among central bankers in Europe and the United States. So do you think the market is going to come around there?
I mean, you said if it catches up the line from the Fed. I guess it depends what line we're talking about. I mean, the Fed officials are saying, we're not going to be easing anytime soon. The Fed staff is saying we're going to have a recession later this year. So those are kind of two different messages. Generally, when you have a recession, the Fed cuts interest rates. I think the market may be a little more aligned with the staff forecasts, right, than what the Fed's saying. But I would agree with the line coming out of the IMF.